Shall we wait 1 more minute, Shilpa?
Yeah, we'll wait for 1 minute.
Good morning, everyone.
Good morning.
Good morning.
I request the speaker to come on video. Mr. Barun Roy. Shall we start now?
Good morning,
Yes,
everyone.
Good morning. Good morning.
Good morning. Good morning.
I request our President, Mr. Venkatesubbarao Kalwa, to give his address for today.
Good morning, all. Respected Speaker Barun Roy and esteemed members, Bangalore Value Association, and guest who has joined for this session. I welcome on behalf of Bangalore Value Association. And today's our topic, renewable energy valuation. As you know that the renewable energy is derived from mainly from solar and wind energy, and it's very plays a vital role in today's economy. And as you know that India stands like 4th globally in renewable energy installation, and also like the investment wise, China is the first, the investment made in the renewable energy, but India is slowly becoming into this energy generating. And as a valuer, we have seen a lot of valuation like startup valuations on business models. Whereas this renewable energy plays an important role, you have to understand the business structure as well as the contracts entered with the government or outside parties. And there are a lot of things involved in this like transmission, generation, and which plays a vital role in valuing in renewable energy. And today there are countries where they are running 100% renewable energy, like countries Costa Rica, Ethiopia, Congo. They are generating 100%. It is not that like we are very less in generating renewable energy, but our country is going to be maybe next by 2050, we will increase maybe 50% renewable energy. And it's very critical for valuation purpose. And I thank Binay Roy for accepting to take session on renewable energy. This is the first we are conducting in our Bangalore Value Association. And also I thank Ravindranath for introducing today's speaker. And I also thank Shilpa for coordinating the session to discuss with the speaker, as well as I also thank our Vijaya for arranging this session. And last but not least, I thank Mr. Prashant Agrawal. Sir, you are introducing a lot of members to Bangalore Value Association. Like we started this association, okay, to spread the knowledge among our valuers, because we have a lot of RVOs, whereas okay, they are connecting only CP hours, but whereas we are conducting sessions on for valuation, spreading the valuation knowledge. And yes, I request okay to keep using the members, and okay we have more members. Discussion is more. It is good, fruitful for everyone. Now I request Shilpa to give brief introduction of today's speaker and start the session.
Thanks, Subbarao. Um, I would like to make a few announcements. Last year, we had taken a session for Valuation. This is one of the software which is in the market, which is a valuation tool. So we are in talks with the Valuation management. So we will be soon coming out, after the discussions with them. We are trying for a discount, basically. We will soon get back to our members on this. And one more thing is, in April, we will be planning for a physical session. Very soon, we'll be reaching out to all the members with the dates and all. Okay. Watch out our space for the announcements. Actually, Mr. Barun Rai, I will kindly request you to introduce yourself. Over to you, Mr. Barun.
Good morning, ma'am. Good morning, distinguished valuers and guests. I'm quite delighted to be part of this session, and I welcome you all. Myself, Varun Rai, I work as head of investment in a leading renewable energy power producer. Okay, our organization is a Asia Pacific renewable power producers, and our company has presence across many countries in Southeast Asia, and Australia, and Japan, including India. Having said that, for this session, my organization has nothing to do with it. I'm totally on my personal capacity here, right? And I'm in the industry from last 16 years. In fact, after passing out or completing my master's in 2007, since then I'm totally in this industry itself. I've done nothing else than energy. Right. So I think let's start. Right. I can share my screen, right?
Yes, you can.
So as ma'am and Mr. Subbarao announced that we are here to talk about renewable energy and its valuation drivers. Right? I'm sure you must have done valuation for many other sectors, including renewable as well. Maybe certain things could be redundant, but I assume that there are people who may not have enough exposure in renewable segment. Okay, so with that, let me start. So I will cover these aspects. Okay, so what are the when we say renewable energy, what does it mean? It's what all it covers, what technologies covers, what kind of infrastructure or assets renewable energy sector entails, right? Then what is the market landscape in India for renewable energy? Then I will talk about developing renewable energy projects in India, and valuation approaches and valuation drivers will be the key focus. Okay, so let's come to renewable energy. I think. Yeah, so renewable energy, as Mr. Subbarao told, right, it's primarily including of solar power, wind power. It includes hydro. There are some geothermal plants. There are biomass plants. Okay, so these are in a nutshell, we can say that these are the God-gifted energy sources which are available for us and to harness. These sources have been there with us for a very long time. Okay, I think if we go and try to search the oldest wind turbines and all, there are wood made wind turbines in Europe, right? So these technologies are nothing new, but earlier they were not cost effective and efficient. Now as technology has evolved, this electricity producing equipments and plants have become more efficient and are trend of the day, right? So earlier, what was happening? If renewable energy was not there, then what was where were we getting energy from? Where were we getting electricity from? Right? We were getting electricity from coal plants, gas-based power plants, even hydro plants are also quite old, right? So those were the primary sources of energy earlier, but now we have more exposure and involvement of wind-based energy, solar-based, and biomass and all. And I'm not sure whether how many of you would have got an opportunity to see how does a wind farm look like, right? So just see, I put a snapshot picture of a wind farm. Again, you can see it is in the ocean. So now there is a new move of offshore wind projects. Okay, so this is a picture of offshore wind. You can see it's like rice plants planted in a field, right? So that's how it's looking like, right? Now we have new technology evolving like battery storage. See, the renewable energy is inherently quite intermittent, not reliable. You cannot control wind resource, right? Sometimes it will be quite windy, sometimes it will be, there will not be any wind. Then how do we rely on this wind, right? I need 24/7 electricity in my house, but which source I should rely? If I am totally dependent upon wind electricity from wind plant, then once wind is not there, then my electricity will go off. Right? So similarly with solar, okay, in the night solar energy cannot produce. Solar energy plants cannot produce any electricity. If it is too cloudy, also then the solar energy production will go away. Right, so so that's why wind and solar are tagged as intermittent sources of energy. So gradually people realized this challenge, and they figured out that why don't we store this energy in batteries? Okay, whenever there is too much of wind generation or whenever there is too much of solar generation, let's store that energy into battery, and whenever the wind or solar is not there, then we can discharge the battery to make electricity available for us. So again, this battery is also not a new technology. We have been seeing batteries from our childhood, and maybe our ancestors would have also seen batteries, right? But battery technology has also evolved. It is becoming cost effective, right? So there is not much penetration in Indian market, but obviously battery storage is a big segment in developed economies. Okay, so it has a lot of penetration in US, Australia, and Europe. Right? So battery storage technology is coming into the picture. And I don't know if you guys have heard about green hydrogen. It's like a talk of the day. Every alternate day, you will hear some news about green hydrogen. What is this green hydrogen? Again, from our school days, we have heard about hydrogen. It's nothing new, right? It was always there. Okay, in fact, around it is said that around 70% of the air in our atmosphere has hydrogen. So what is new in it? Again, same thing. Earlier hydrogen production and handling was too costly. Now technologies are evolving, and it is becoming cheaper. Right, hydrogen can be extracted from water. Right, water is made of hydrogen and oxygen. Do you guys remember the chemical formula of hydrogen? Water. It's H2O. Means there is in one molecule of water, there is two molecules of hydrogen and one oxygen. So there is plenty of hydrogen available with us. So so now the technology has evolved to extract that hydrogen from water using green energy, renewable energy. So that's where it is tagged as green hydrogen. Otherwise, hydrogen can also be extracted from natural gas, which was there since very long. Okay, so the solar and wind electricity will be used, and water will be split between water will be split amongst hydrogen and oxygen components, right? And that hydrogen can be utilized further for either electricity generation or in any petrochemical complexes or any other purposes. Okay, so these are the evolving technologies and in the renewable sector. Whoever has more exposure in the renewable sector, you will definitely hear these technologies very soon. Right? Now, coming to Indian market, what's happening in
why did you say it's called a green hydrogen?
Okay, so green tagging is associated with renewable energy. Okay. What does it take to split water? It takes water can be split by using electricity. Okay. So even let's say renewable energy was not there, right? We could have used that our old method of getting electricity, let's say from a coal power plant, okay, or a gas power plant. That electricity can also be used to split water into hydrogen and oxygen, but that hydrogen produces will not be called as green hydrogen. Okay, the whole world is focusing on green technology and carbon neutrality, right? So if I burn coal, okay, to produce hydrogen, then burning coal produces CO2, right? So then it's not in favor and it's not in the direction of carbon neutrality, right? So that's why what the world is talking about is let's get rid of coal and natural gas. Natural gas again is methane, right? CH4. P stands for carbon. Okay. You see in in water there is only two hydrogen, H2O. But in methane, CH4, 4 hydrogens are there. But still people are saying no, don't use CH4. Why? Because of that C. That C, once you burn methane, C becomes CO2. Okay.
You mean to say Adani Greens and all are pertaining to this field?
Sorry, sir?
I think Adani Greens and all companies regarding green energy, no?
Yeah, correct.
Understood.
So that's why it is taking. So there is a lot of lobbying and lot of discussion on this green hydrogen. Okay, all these petroleum company and oil and gas companies, right, who have been extracting gas, okay, from our ground, right? Most of the countries have natural gas resources, primarily Middle East, right, which is rich in oil and gas. Okay. So in fact, Middle East is a bit upset with this lobbying. Okay, that God had gifted us this natural resource in the form of natural gas. We have been using natural gas for so many years, and now the industry and people are saying that okay, don't use that naturally available natural gas, right? Because it is against the carbon neutrality principle. So what is it? Yeah, so that's why people are talking, okay, forget that one, don't use those carbon emitting stuff, okay, because it is leading to global warming. And you must have heard there are many side effects of global warming and all, right? So, so the whole focus is on net carbon neutrality, okay, and that's where this green tagging keeps on coming. Okay, that's a green. That's why it is green hydrogen. Now, your plastic, even at home, right, is made of petrochemical thing. Okay, so petrochemical, they involves like polythene, right? It has hydrogen in it. Okay. Now, if those factories which are producing plastics, okay, or even let's say, what should we say? Let's say our washing machine have a lot of fiber and plastic kind of stuff, right? So if whichever manufacturing companies are there, right? Let's say who is manufacturing washing machine, Whirlpool, okay, or Samsung or LG, right? If they want to tag their washing machines tomorrow that okay, these are green washing machines. Okay, means those fibers and materials which are used have been produced using green either energy or green feedstock, right? So those factories need feedstock in the form of hydrogen. Okay, so if they source green hydrogen from green hydrogen producing companies, then they can eventually tag their washing machines as green washing machine. Right? There is even for electricity supply, there's a green tagging system is coming in. It's already implemented in Mumbai. It's being supplied at premium. Okay, so some customers, okay, some premium customers, they are saying, okay, I don't want to. So they have their own policy towards carbon neutrality, right? So they, to achieve that policy and objective, they will say, okay, let's say here in Bangalore we have Bescom who supplies energy, electricity in our houses, right? So they will say, Bescom, okay, Bescom, you don't give me general electricity, you give me green electricity. Okay, so that they can tag that, okay, I have avoided so much of carbon emission. Right?
Understood.
So that's the underlying philosophy of green neutrality. No, sorry, carbon neutrality.
Thank you.
Okay, so coming back to the penetration of renewable energy in India, okay, I'm not sure whether all these numbers are make sense to you or not, but electricity generation capacity, okay, the capacity of any country is measured in megawatt or gigawatt, okay. So India has 412 gigawatt of electricity generating capacity, okay, and through this chart, I have tried to show that what are the different underlying sources, okay, which are used to generate electricity. If you see, still after so much of renewable talk and all, coal-based electricity accounts for 50% of the total electricity capacity in India. Okay. Then it's followed by gas, which is again accounts for 25% of electricity in India. Right? Then our hydro plant. Okay? I don't know, have you guys seen any hydro plant? There is Almaty Dam and many dams which are made by the government and various authorities which produce electricity from water. Okay, these can be a dam-based project, or it could be a runoff river where the river is flowing and some turbine is put in between, and the flow of the river moves the turbine, which helps produce electricity, right? So you can see the wind-based capacity accounts for 10%, solar accounts for 16%. So, and there are other technologies like waste to energy and biomass and all. Okay, so total renewable capacity accounts for just 30% of the India's installed electricity generating capacity. Okay, and government is targeting this capacity. So currently, it's this 30% of total capacity is 122 gigawatt. Okay, and government of India is targeting 500 gigawatt of renewable energy capacity by 2030. Okay, and what do the government do for that? They come up with regular tenders and bids, and IPPs like our companies and many other companies participate in those tenders and win the tenders to install these renewable projects. Okay, so that's how government is supporting and enabling increase in renewable energy share in the overall country's electricity mix. Okay, and then who are the producers? Who are these companies who are generating electricity and all? Okay, so there are many. There are central government entities like NTPC, NHPC, NHPC, the SGVNL. So there are central government entities. There are state government entities. Like for Karnataka, we have KPCL, Karnataka Power Corporation Limited. Right. Similarly, we have in Gujarat, we have Gujarat Urja Vikas Nigam Limited. Okay. In Tamil Nadu, we have TANGEDCO, like Tamil Nadu Generating and Distribution Company. Okay, and then there are private sector companies. Okay, so government has, you would have heard and you would have followed, if you would have followed the news, then government has always been promoting private sector investment. Okay, and its result is that today 50% of the electricity generating capacity is owned and developed by private sector companies. Right, you see in this pie, right, around out of 412, 207 gigawatt is owned and has been developed by private sector companies. And who are these private sector companies? These companies are, let's say, Renew Power, Adani Power, Azure Power, Sembcorp Industries, right? Yeah, so these are the leading India-based power producing companies. Okay.
Is there an impact on the transmission and distribution for a renewable power, or is the same thing? Once it gets generated, rest of the things are same.
Yeah, once it is generated, then the electrons and electricity is same. You cannot distinguish between renewable energy electricity versus coal-based electricity. Okay, it's just an electron. Okay, and from a transmission distribution perspective, there's no material impact. The only thing is, as I said, that this renewable technology is primarily intermittent, right? So the coal is like kind of a flat, fixed kind of profile. It will keep on generating at a stable rate, but renewables, the capacity and pumping it in the transmission system will depend upon the flow of wind, right? If it is a high wind period, then it will pump in more electricity into the transmission system. If it is a low wind season, then it will pump very less. Okay. Yeah. So, but as you asked, means there is no material impact on transmission and distribution system. Only thing is the renewable system creates a lot of fluctuation in the grid. Okay, so that's why whenever this renewable penetration increases too much, right, then we must need to augment with battery to stabilize the profile. Okay, otherwise it will lot of fluctuation. So what does it mean? Let's say if our whole capacity in India would have been totally on the renewable energy, then what would have been facing? Okay, we would be facing with sometime high voltage, sometime low voltage, sometime no voltage, right? So, but fortunately, we have currently only 30% of penetration of renewable in our electricity mix, right? Okay. If there are no questions on this slide, then I can move to next one.
Is it just from a valuation again? I'm getting into that.
I'll come into the valuation aspects very soon.
I'm talking about physical infrastructure. Is there a
Sure.
typical? I understand in a traditional power generation, there's a lot of gap. Sorry, can you hear me? Sorry,
Yeah.
can you hear me? Yeah.
Yeah.
See, you cannot just shut down and start again power infrastructure, at your whims and fancies in a traditional power setup. And that means if it starts, it stops, and there's a lot of cost involved to redo that part of it.
Correct.
From that perspective, how it is different from a renewable energy setup?
So let's understand the underlying principle. Why does it take a lot of effort, cost, and time for stopping and starting a conventional power plant? Okay, conventional power plants are thermal-based power plants like coal and gas. Okay, they operate on turbines. Okay, and turbines are moved by steam. Okay, so the boiler there's a boiler furnace, okay, which burns coal and produces heat. Okay, and that heat is utilized to produce steam. Okay, so like we have seen in our home, right? Once we put a utensil with water on the gas stove, it's not suddenly, it will not start boiling, right? It will take some time to reach that boiling level, right? Similarly, if we stop a plant, right, if you switch off the gas burner and then switch it on, right, it will not suddenly start boiling and start generating steam. So that's why you understand, right? That it takes some time.
Yeah.
Similarly, in that conventional power plants, when we stop and start, right, it will take time to heat up the water and start generating steam. Again, steam has to be also it has its own characteristic. The required temperature and pressure has to be achieved, right? So once the required temperature and pressure is achieved, then it can be used to generate power. Okay, so for reaching to the required temperature and pressure of a steam, it takes time. So that's why it is it takes a lot of cost for switching off and switching on a conventional power plant. While for renewable, it does not take anything. Okay, wind is not there, the turbine automatically, it's kind of a fan, right? The fan will automatically stop. Okay, whenever it is windy, the fan will start moving. Okay, there is no fuel involved, there is nothing we need to burn to move that turbines and then fan, right? Similarly, the solar panels, it's just like a glass. Okay, whenever the sunlight falls on it, okay, it starts producing.
Understood. Understood. That's a positive thing for renewable energy.
Yeah. Okay, then I'll move to the next slide. Okay, now I'll come directly to the valuation approaches. Okay, now you are all expert in valuation, so it may not be sounding anything new, but let me just repeat. You guys could even help me upgrade my knowledge itself. But I understand that there are three broad valuation methodology and approaches, right? One is the cost based, another is the market cap comp based, and the third one is the DCF method, discounting cash flow method, right? And each of these approaches and methods have their own utility, right? For an accountant, for a CFO who is doing bookkeeping and accounting, the cost-based valuation method is the most useful method, right? Because there's the cost-based approach is only carried on the balance sheet, right? Then is the market comp approach. So what is the purpose? Where do we use market comp? Okay. It's good. It gives a ballpark indication of evaluation. Okay, I hardly believe that anybody would be doing any transaction on market comp. Okay, these are good to arrive at a ballpark number. Okay, whenever we do an M&A, okay, acquiring any company or project, okay, we just do a quick valuation on market comp. Okay. In our day-to-day life, at least in my role, I see an EV to EBITDA multiple to be quite useful. Okay. Again, from an equity perspective, it depends from market to market. In India, there are not many renewable energy companies which are listed. Okay, so the listed companies in India, I think one arm is Tata Power. Again, Tata Power is not fully a renewable company. It is mix of thermal as well as the green component. But then is Adani Green. There is Adani Power, which has all thermal plants and all. But they spun off Adani Green, and Adani Green is also listed. Okay, but you guys have recently heard what's happening with Adani, right? It was the valuation was too much ballooned and inflated, and after a report, that Hindenburg report, the whole valuation has collapsed. Okay, so that market camp was totally unreliable. Okay, but this matrix is quite useful in matured markets where there are multiple companies which are listed in the stock exchange, and the valuation of shares are determined in a more prudent manner. Okay. Having said that, these market comps are quite useful in arriving at a ballpark valuation. Okay. So what then the next approach is DCF method. Okay, it is used again for investment evaluation perspective. Whenever we go in our company to propose, okay, that we want to set up a new plant. Okay, so our committee and our board asks, okay, give me the valuation, and the valuation we have to present on a DCF method. Whenever we are evaluating any M&A opportunity, that in that process also we use the DCF method to arrive at the valuation. Also, if we are converting any shares, right, as per regulations, we need to do a fair market valuation. And for FMV, typically DCF method is the most reliable one. Yeah. Now, having said that, I think you all will concur that the DCF method is the most widely used valuation method, right? Means what I would like to hear from you, that what's your feedback on?
I was actually thinking, whatever cost I have incurred on those solar panels and all of that, whether the value of the company can be related, like suppose I'm interested to get more funding. Okay, and the investor is asking what is the value of the company. One approach is definitely DCF, but can we also consider this, like this is the cost I have incurred, and it is more asset based, right? This kind of companies. So this approach, you have seen the market, so I want to understand the market perspective, like whatever cost I have incurred versus whatever income I'm going to generate. What is the common accepted method? Market multiples is definitely there. So how have you seen the market approach? How investors invest in a solar company?
So we considered the cost. It's a mix of the cost we will capture, and then is the income approach. The DCF method only we utilize. I said that for investment approvals and all, even for whenever we evaluate any inorganic growth opportunities and try to acquire any other project or company, we follow the DCF method only to arrive at the valuation.
See, the problem in cost method is that these technologies are very fast changing. So if you purchase something for 100 rupees today, tomorrow it's available for 90 rupees, a better version of it. So the cost is of, I don't think there's any sense in this kind of a fast changing technology companies. No?
Sir, simultaneously, like for solar panel, you have a fixed life, like 25 years. Whereas in hydro projects, definitely it has got a longer life for the capex part of it. But for solar panel, say 25 years. Post 25 years, solar panel definitely will require a change. So in that DCF method, you have got to be factoring in those replacement of solar panels as well. Am I right, sir?
So, fine, sir. So there are two aspects. One is the solar panels keep on degrading. Okay, there is a degradation profile. Generally, it is below 1%. So it's between 0.7 to 0.5%. Every year it keep on degrading. Okay. So that 25-year is the module supplier gives us a 25-year product warranty. Okay. That the product will be alive, means will be functioning for 25 years. But they also say that, okay, it cannot function at the same level. It has a degradation profile. Okay, so you keep on degrading. Okay, so let's say it is degrading 0.5% per year. Okay, so in 10 years it would have degraded 5% from the original, right? So that time you can buy new modules and add more modules there to the extent of whatever has degraded. Okay, again it's not very straightforward. Again, it depends on the contract also with the off-taker, right? So if your contract is saying that, oh, tomorrow you cannot increase, okay, then you cannot do it. I'll give you an example. Okay, a couple of years back, I was doing evaluating an M&A. Okay, and the underlying project was a project in Maharashtra. Okay, it was the PPA, the tariff rate was around 19 rupees. Do you know what is tariff, right? Means, have you guys noticed what is the rate of, at what rate BESCOM charges you? Do you read the
5 to
bills
6
when
rupees.
it comes?
Yes, it is in the bill.
Yeah, so generally, most of the people don't read it. Okay, simply, okay, what is the outstanding? I'll pay it at the end of the month. But if you please feel free to spend some time and read the bill. Okay, the first 50 units are some lower rate. Then next 50 units are some different rate, and the maximum rate I think is going some 7.5 or 8 rupees kind of. Okay. But that PPA, that project has 19 rupees tariff. Okay. Again, built some 10-year back, and 10-year back, renewable energy cost was too high. That's why it was not so prevalent, right? And but the government was promoting renewable energy, and for that promotion, they even allowed building a 19 rupees renewable energy project that time. Okay. Now, do you guys know, Miss, at what rate the new renewable energy power plants supply electricity at?
6 rupees?
Less than 3 rupees.
Yeah, it's less than 3 rupees, sir. Okay. It's yeah, it's less than 3 rupees, and BESCOM is buying those powers as well at less than 3 rupees, but they charge 8 rupees and 7 rupees to you. Okay. So, yeah.
Just to add for a valuation purpose, since you're saying it's mostly an intangible asset here. Renewable energy cases are on intangible because the location is very critical when you are looking at a valuation. Because each location can, like windmill, you need a location to generate so much extra because of the wind and direction and everything. The second thing is licenses. It's not that anyone can do it unless they get a license. Therefore, the value is for a license. So the traditional intangible assets are a big role in a valuation of a renewable energy space. Is what I think. Am I right, sir?
You are mostly right, sir. I'll come to that segment as well, and I'll throw some more light on what you are saying. Right? But coming back to that.
One question,
Yeah.
sir. What is the explicit forecast period which you consider when you're doing these acquisitions?
Let me complete that example which I was quoting, that 19 rupees tariff. Okay, so that project was 19 rupees tariff. Okay. Now, as I was saying that it was 10-year-old, ideally, we should be allowed to add more modules there, because in 10 years, almost 5% to 7% of the project would have degraded, right? So whatever it has degraded, I should have been allowed to put more equipment there so that I can again reset to normal level. But the contract says that you cannot add it. Okay. Why we cannot add it? Because let's say if I add it today, okay, it is very beneficial for me that today's new equipment, electricity produced from today's new equipment is available at 3 rupees. But if I do it in that PPA, I will get 19 rupees. So these kind of challenges the regulators and the counterparties recognize, and that's why they typically don't allow adding more capacity down the line. Okay. Yeah, so I hope I answered somebody amongst you had asked that tomorrow what happens if the solar panels are degrading. Right? So it's pretty contract specific, and some quite in old PPAs it's not allowed. In recent power purchase agreements, it is allowed. Yeah. So yeah, fine, sir. Somebody has a question.
The explicit forecast period, what is it that you consider when you do acquisitions for valuations?
Fine. So again, the typical approach has been 25 year, and why 25 year is one is the product warranty and also is the contract period. Okay, but now market is evolving and the contract periods are changing. Okay, but the typical period has been 25 year, and we consider 25-year cash flow and discount.
Right. So typically in these agreements, they would be having inflation built in, or how would you handle it?
Fine. Let me come to those drivers. Please allow me.
Okay. Right.
For
Please.
that.
As you wish.
I have covered those aspects in later slide. Okay. Now, let me throw some more light on the DCF methodology, right? Again, I hope you will all acknowledge that this is a bottom-up approach, right? We need each and every granularity to arrive at the cash flow, right? And hence the underlying assumptions play a major role in valuation through DCF method, right? And how do we value in a company or project through DCF method? We generally consider FCFA, free cash flow to the firm, FCFE, free cash flow to the equity, or distribution. Okay, and we discount them at appropriate discounting rates to arrive at the valuation. Okay, if you discount FCFF, then what do we get? The FCFF is at firm level. Okay, so the discounting rate should be WACC, the weighted average cost of capital. Okay, so if you discount FCFF at WACC, then you will get enterprise value. Okay, and how do we get the equity value then? The enterprise value minus net debt. Okay, net debt is the outstanding debt in the book minus cash balance. Okay, is the net debt, right? So enterprise value minus net debt. If you do, then we get the equity value. So that is the basis FCFF discounting approach. If we have FCFE available, we can directly discount FCFE as well at cost of equity to arrive at the equity value. Okay. Then we have dividend distribution discounting approach, DDM method, distribution discounting method. Okay, which takes into account many other granular aspects of a project or a company. Okay, and that in DDM method also we take cost of equity for as discount rate to arrive at the equity value. Okay, I believe this is DDM method, the dividend discounting method is the most accurate and appropriate way to discount the business. Okay, and would anyone mind commenting on this? Why am I saying so? Why do you think that? Or do you concur? If you don't concur, then please raise it. Means why do you think it should be or otherwise?
It looks like you're taking a utility approach where basically the cash flows over a significant period of time are going to be steady. Therefore, the return to the investors will only be the dividend. That seems to be the theory, I think.
Correct, sir. So it's about investor, right? Investor has put in money. Okay, so the money has gone out of their pocket. Okay, so the valuation should be whatever is net come back into their pocket. Okay, and that measure can only be only measured through dividend or distribution discounting approach. Yeah. So I think that's all on this slide. I'll move to the next one. Right, Shilpa ma'am, do you have any question or should
I have a question.
Sure.
Do you have any reservation? Basically, what I want to say is all the Bangalore Valuer session are hosted ultimately on YouTube. So do you have any reservations of this session being actually recording is on? So do you have any reservation in?
Yeah, ma'am. In fact, I'd request let's not post it.
Okay.
Even recording. Okay, fine. I was not
Recording
aware
will
that it would
be
be.
internal. It will be stored.
Yeah,
Internal. Even the admin has been alerted about this. Just for
Sure.
the benefit of viewers, I would like to say that, the speaker has some reservations in hosting it on YouTube. So any queries, anything, please let us complete it in the session itself.
Sure. And do you have any time limit, ma'am? Then I'll try to. I think
Normally it
I-
is 9:30.
Okay, fine. Because it's going to be around 1 hour. Okay, so I'm running very slow. Yeah. So fine. But any further question on this slide? Else I'll move to the next slide. Okay. I assume nothing further. So let's move to the next one.
Sir, one question on the slide. Can
Sure.
you please explain this utility approach of valuation, which was said dividend by distribution?
Yeah. So see, investors have put in money, right? They have invested into a project, right?
Right.
So the money has gone out of their pocket. Okay.
Mm-hmm.
So let's say I borrowed some money from you, right? Okay, I requested you to please put, let's say, 100 crore in one renewable project. You agreed to do so. Okay. Now, how will you value it? Okay, I will say, okay, whatever you invested into that project is generating money. Okay, but that money is there in my bank account. Please see it. I will send you the bank statement every month. Okay, you please be convinced that your investment is generating money, but I am not giving money to you. Will you be happy? And how will you do value? How will you value such investment?
No, I will not be happy. I would
Right.
definitely look.
So that's why I like to explain in this approach that once you started getting in money, right, that cash flow you should consider to value your investment, right?
Okay. Okay.
Right. So, and that cash flow is what? That cash flow is dividend. That cash flow is distribution. Okay. Distribution to its investors, to its
Okay.
shareholders. Right.
Okay.
Once we take into account, then it gives a proper valuation of that investment or of that asset. Right.
Got it. Got it.
Yeah. I picked up a quote from this Mr. Daniel Palopa. What is he saying? That all these, there are various approaches for valuation. Okay. All these are scenarios, but each of this approach has its own risk and reward. Okay. So we must keep into account that what is our ultimate objective, and is it just a ballpark valuation? Is it about bookkeeping? Okay, or is it about doing some transaction or investing into a new company? And again, what are the investor philosophy that also matters? Okay. So with that, I'll move to the next slide. Okay. Now let's talk about the valuation driver. Okay. Can I request some of you could, if you guys would be interested to citing the valuation drivers, what could be the valuation drivers of a renewable project?
It should be the PPA first.
Okay, so PPA. Okay, fine. What else?
Because PPA will decide the cash flows. No?
Sure, but PPA will decide the incoming cash flow.
The location
what
of
he's
the
saying is
project.
the rate per unit and at which you are selling and
Yes.
the rate per unit at which you are manufacturing.
Correct.
Which
So
you are producing.
PPA, what does the PPA have? PPA have generally the rate, the tenure of the contract, and any minimum guarantee, okay, or any cap that how much of units or electricity you can sell to the counterparty, right? So those drivers it determine. But what if my plant is not generating to that level? Okay, or what if my plant is generating more than what is contracted into the PPA? Right. So So that's there. So apart from let's come up with the key drivers which I've thought about. So one is the
Uh,
capex, right? When we are doing
Sir,
valuation.
solar radiation levels and your
Exactly, sir.
plant capacity and that reduction it will be having over a period of time, that is a loss in production. Those could be.
Exactly, sir. So,
Thank
Whether
you.
location of the project has got any relevance to drivers?
yes, it has, ma'am. Okay, so
Transmission is also the responsibility of the producer, is it?
transmission to the nearest grid substation is the responsibility of the developer. Okay. So the key drivers
What about
here
transmission losses? What about, should we also account for transmission losses?
yes, ma'am. Again, it depends upon till what extent. So it depends upon the underlying contract. So as Mr. Ravi Shankar told, that the PPA is the driver, it is the power purchase agreement. Under the power purchase agreement, there is an agreement that till what point you as a power producer obliged to supply electricity at. Okay, so in the PPA, it will be decided, okay, this is the address, or the address means the grid substation name, or a general thing for grid name, that till this point you have to bring electricity. Okay, and whatever transmission losses has been incurred till that point has to be borne by the developer. Okay, any transmission line losses beyond that point will be borne by the counterpart. Did I clarify you, ma'am?
Yes, sir. Thank you very much.
So whether any profile of the promoter or experience of the promoter really matters as a valuation driver?
From a pure number perspective, ma'am, it does not matter. Okay, but there are many underlying drivers where those aspects are taken into account. Okay, like each project, whenever it goes for borrowing, okay, whenever it goes for debt financing, right, the credit rating and the profile of the management and company is taken into account. Okay, if we have a good promoter and good track record, that will reflect in my credit rating, and that credit rating will drive my interest rate, at what interest rate bank will give loan to me, right? So that's where it matters. And also, when we are participating in a new tender for securing an order to develop a project, the government requires eligibility criteria. Under the eligibility criteria, we have net worth requirements, we have liquidity requirements, we have to furnish bid bonds and all. Okay, but these things are quite diluted and not so stringent, so that the government can allow new market players. Right. So that's why those are not too stringent part. Okay, but obviously it matters from a competitiveness perspective. Yeah. So fine. Yes, sir.
Sir, most of the PPAs may not be there for the full life of the company's 25 years. It will be there for 3 years, after that, or maximum 12 years. And there are clauses that one can exit after 3 years without any loss. Now, in such a scenario, when you are making projections for 25 years, I think that's what I think one of our colleagues
Yes, sir.
here.
Fine, sir. Sir, I would request, why don't you remind me if I go to the to that respective driver? Okay, I would love to talk more about that, what you've asked.
Yes, please.
Okay?
Thank you. Thank you.
But let me quickly cover the valuation drivers here. So one is the capex, then is opex, then there are revenue assumptions. Okay, and then we have financing, depreciation, and tax. Right. So these are other assumptions which drive the valuation of a company or a project. Okay, now coming back to the capex. Okay, so as many of you know, that what does it involve? What kind of capital expenditures we need to make? We need to procure land. we need to procure equipment like wind turbines or solar panels or battery storage. We need to build transmission lines till the grid substation so that we can inject our generated power into the grid. Okay, for putting up these transmission towers, okay, the underlying ground, for the underlying ground, we need to secure right of way so that so the farmers gives us right of way to put a transmission tower there. Okay, we need to secure aerial right for those transmission lines. Okay, you would have seen that these transmission lines are spread across kilometers and kilometers. Okay, so what happens is, can I go and string a transmission line over somebody's land without their consent? You must be thinking about it, right? That how can that these kilometers of kilometers somebody is putting line? What's happening? Okay, are the farmers aware of it? Have they given consent for it? Okay, so all those things come into picture, and we need to take approvals and permit for evacuation. Evacuation means for injecting the generated electricity into the grid. For that, we need approvals, and there are permits related to land, related to, let's say, pollution, related to putting a high structure. Okay, you cannot like directly go and put a wind turbine which is roughly around 200-meter tall. Okay. Then we have ITC, interest during construction, and other financing costs which are involved. Okay, so all these things lead to capital expenditure that needs to be incurred for building a renewable project.
As per your experience, do you think the farmers and all will create a problem for this right of way or aerial rights?
Yes, ma'am. It's the biggest pain in developing a renewable project.
Okay.
Yes, there is sometimes protest. There is sometimes lobbying. Okay, today they will say, okay, I will take 5 lakh per acre. Tomorrow they will say, I will take 7 lakh per acre. They will say, oh, the other developer is giving me 10 lakh per acre. Okay, you give me 10 lakh per acre. Okay.
So we have to have a parallel agreements with them for maybe for the period of PPA.
Correct. Correct. Okay.
Are
Now,
environmental clearances more difficult for a green renewable energy than a thermal, or both are same?
no, for we typically don't require any environmental approval for the renewable project. Okay, we just need an intimation. Okay, to Pollution Control Board. Okay. Then okay, so what should we conscious about? Okay, from capex perspective, and we can validate, okay, whether the underlying capex is roughly correct or not. So how can we do that? We can do benchmarking. Okay, that how much typically per megawatt it costs. Okay, so where can we find such information? We can find such information in investor presentations of listed companies. Okay, so you can go and open Adani Green's website, find its investor presentation, and see how much it costs. Okay, per megawatt. Okay, and from a capex perspective, we must be conscious that do we need a replacement capex? As some of you were asking earlier, that okay, will most of the equipment work throughout the life? Maybe not. Okay, so let's say there are inverters and all which requires refurbishment or replacement 6 year, 5 year down the line. Okay, so though whether in my cash flow those major or replacement capex has been factored or not, we should check before completing our valuation exercise. Okay. Then I'll move to next slide. That's on OPEX, operating expenditure. Right. While renewable projects does not have feedstock, they don't have any fuel to burn. Okay, but there are other costs involved to run a renewable project. Okay, what are those? We need a wind or module or battery operating and maintenance contractor to operate and maintain this wind and module turbines efficiently. What does it mean? We need to clean those wind blades regularly. There could be some failures and malfunctioning which needs to be fixed in time. Okay. Similarly, the modules, solar panels needs to be cleaned so that it's not covered with dust and proper sunlight is falling on it. And similarly, balance of plant means other infrastructure. Let's say it will have transformer, other switch yards, and other equipments which needs to be operated and maintained in an efficient manner. Then we need project security guys so that none of the so that the property is not damaged and it's well taken care of. Okay. Then we have transmission lines, which are kilometers of kilometers. Some contractor needs to maintain it, okay, and take care of it that it's not damaged or it has not tripped. Okay. Then we have sometimes if land is not purchased on a sale basis and it has been acquired on a lease basis, then we have land lease payout, okay, that needs to be paid. And there are certain taxes which needs to be paid. Then there could be some small consumables or spare parts which should cost us to run a renewable plant. Then there could be auxiliary consumption, and auxiliary consumption means this whole renewable plant will have one big room where the various control equipments will be hosted, and it will require some lighting and fan and let's say AC as well, right? So let's say once wind is not there or solar is not there, then how will my fan or AC or lighting will work? Okay, then we need to draw from the grid. Okay, and that requires that is called import units or auxiliary consumption. We need to pay for it. Okay. Then we need to hire a consultant to forecast and schedule that when, at what period of time, how much electricity will be generated and all. Okay, so these are the typical OPEX item for a renewable plant. Okay. Now, what do we need to take care of it? Let's say if we have to validate whether the OPEX assumptions they are provided by the client is correct or not, then we can do a quick benchmarking. Okay. Again, we can source those investor presentations and see how the OPEX is looking like. Okay. From a cost perspective, we need to look into the O&M contracts, that how much, what is the tenure of the O&M contract. Let's say it is only 5-year O&M contract with let's say no escalation. Okay. So after 5 years, what should be the assumption? At least the inflation angle should be taken care of, right? So those factors will come into picture, and it can be established only through having due diligence or going into the O&M underlying O&M contract, right? Just for a ballpark number, typically we have seen 85% of EBITDA margin. So if whatever project you guys are evaluating, if you see that the EBITDA margin is 99%, then you must be allowed. Okay, or if you see that the EBITDA margin is too low, let's say 60%, 70%, then also you must be alert that why it is so. It is an aberration. Okay? So that aberration needs to be analyzed further and identified the root cause of it.
Here the raw material cost is zero, literally. Only the workforce who are the labor engineers and all that is the only cost.
Correct, sir. So there will be staff, okay, at each plant, okay, so that they are ready to do any preventive maintenance if it is required. Okay, and ensure safety of the plant and equipment. And sir, can I move forward?
Yes, sir.
Okay. Now this one is the key one. Now coming back to the revenue drivers. Okay. Now how do we get the revenue of the plant? revenue is equal to generation of the plant, okay, into tariff, which will be written into the PPA. And then after that, any adjustments, okay, if it is required. So how do we arrive at generation? We have a capacity of the plant. Let's say it's a 100 megawatt plant or 200 megawatt plant into CUF, which is capacity utilization factor. Okay, now this CUF capacity utilization factor is very location specific, site to site specific, and also from a plant design specific as well. Okay, solar panels need to be tilted and it should be south facing. Okay, if you put up a solar plant panel which is like north facing, then it will not generate much, because you would have noticed the solar sun will rise in east and it will move towards south and west. Okay, so that's how it moves, right? So that's why the panel needs to be facing that direction so that it gets maximum exposure of sunlight. Similarly, wind turbines, they cannot be put too close. If you put too close, then one wind turbine will block wind for the other wind turbine. Okay, so that is called wake effect. Okay, so then if you put wind turbines too close, then there will be the internal losses. Okay, so and again, wind resource is also pretty specific. Not all areas or region have similar wind resource. Tamil Nadu coast has good wind resource. Karnataka, North Karnataka has good wind resource. Okay, even Gujarat and has good resource. Right, and from a solar perspective, Rajasthan, Gujarat, even North Karnataka, Telangana have good solar resource. Okay, so we also need to be cognizant that in what regions, what areas, what kind of irradiation can be expected. We cannot expect Rajasthan like solar radiation in let's say in Andhra Pradesh or in Kerala or Tamil Nadu. Okay. Yeah. So again, what should be the capacity utilization factor assumption? If you are valuing an operating plant, okay, which has, let's say, 4 years, 3 years of operating history, then your job is much easier, okay, because you have a track record of it. You can take an average generation and calculate the capacity utilization factor. Okay, but if it is a new plant or has a very limited operating history, then how will you take the capacity utilization factor assumption? For this, generally, companies have a resource assessment report by a technical consultant. They provide the estimate for this generation, and they provide a probabilistic output. Okay, so P50 means 50. P stands for the probability. So they will quote a generation at 50% probability, 75% probability, 90% probability. Okay, and basis that probability, investors and valuers can take call and arrive at the valuation. Generally, when we do investment, most of the companies, in fact, not only we, means in most of the companies follow P75, means 75% probability of that generation level for wind project valuation and 50% probability for solar generation. Yeah, so I think here, I think Shilpa, you were asking whether it is location specific. So that's where that's how I explained that how it is dependent upon location and layout of the plant. Okay. Now, some of you mentioned that the PPA is the key driver for valuation. Okay. Now, so coming back to that aspects, it is called off-take arrangement. Off-take means taking.
Sir, I'm just interrupting.
Sure.
See, in your generation capacity into CEF into 8760, what is that?
That is number of hours in a year. So if you multiply 24 hours into 365 days, you will get 8760.
Okay, thank you, sir.
Sir, even I have one question.
Yeah.
This solar panel directions are India specific. So, for an example, if an Indian company is allowed to do the power generation and all in a foreign country, so in that case, how the valuation will be? I mean, it's just a random question. I don't know
No,
about
no,
FEMA
but
regulation and all that.
it's a very good question, ma'am. And again, it's not a government controlled thing. It is sun controlled, and in sun and earth dynamic which plays into role. Okay.
Okay.
So if you
Mhm.
go to Southeast Asia like Thailand, Malaysia, and all that, that angle and direction changes.
Right.
Okay.
Mhm.
Right. So it is location specific. Again, in South India, we will have, I think, less tilt. Means it will be more flat. Okay. And if you go towards north, like Gujarat or Rajasthan, then it has to be more tilted. Okay, towards south and yeah. So this is flat, right? It's totally flat, facing full into the sky, but it has to be tilted slightly. Okay.
Okay.
And that tilt is specific to each location. Okay. On the earth. Okay. It will be different in Russia. It will be different in Australia. It will be different in South America. It will be different in Japan.
Okay. Okay. Right.
Yeah. So it's not government specific, but it is earth and sun dynamic.
Sir, want the direct feed or storage power plant factor also be a criteria for cost and valuation perspective?
Obviously, sir, if we are adding more storage into this project, that needs to be factored into the capex, right? And that will also affect our generation profile, right?
Yeah.
So that needs to be taken into account. Now coming back to the PPA aspect, right? The PPA typically have it will have tenure. Okay, like some of you were saying whether it will be a 25-year PPA or 5-year PPA or 3-year PPA. Generally, government PPAs in India are 25-year PPA. Okay, there are niche market segment which is that is for private PPA, and those private PPAs are for a smaller period, let's say 5-year and 10-year period. Okay, and most of the government PPAs have no escalation or inflation clause. Okay, the tariff will be fixed throughout the 25-year period. But in private PPA, it can be structured. Okay, nowadays it has become, they are also preferring flat tariff, but earlier there was a discount-based approach. Okay, let's say whatever is BESCOM charging them, I have to supply them electricity at, let's say, 20% discount to the BESCOM rate. Okay, so BESCOM, whenever they revises their rate, okay, my rate also get changes. Okay, it will be always at 20% discount to that. Okay, or we can agree to a, let's say, 2% annual escalation. Okay, so every year the tariff increases by 2%. So these kind of constructs can also be agreed and can in the power purchase agreement. Okay. Now there are plants where, let's say, the plant is 100 megawatt, but part of that 20% of the plant is not contracted. Okay, it is then what happens? Okay, then we need to sell that power into the power exchange. In India we have 2-3 power exchanges where we can sell the electricity into the power exchange. Okay, and get paid for it. Okay. There are additional revenue streams like carbon credits. Okay, so now carbon market has become quite prevalent. Okay, so there is carbon credit mechanism. Okay, typically 1,000 unit is labeled as one package, and that is considered as 1 unit of carbon credit. So, and these carbon credits can be sold into the market and you can earn revenue. Okay, so somebody can consider carbon credit as well in their revenue stream. Again, it's not very blanket. There are eligibility criteria involved for carbon credits, and also not all projects can avail carbon credit. Okay.
What is the assumption for revenue on carbon credits, sir? Typically, which you consider?
It varies from time to time. What we understand that it typically has varied between $2 to $3 to some $8 per carbon credit. Okay.
Thanks.
Yeah.
What is the in your valuation calculations? What you have done, sir? What is the typical ratio of this uncontracted revenue to the contracted revenue in your estimates? Typically, you take.
Typically, you see, most of the companies don't prefer building a project which has exposure for uncontracted revenue.
Okay.
Okay, these carbon credits are these are like just cream on the cake, right? But nobody builds a project just for the carbon credit. Okay.
Okay.
Yeah. So
So
because
if it
nobody.
is a percentage, can it be some 10% of the revenue or something like that?
I think we need to calculate, ma'am. As I said, it can vary between $3 to, let's say, $10 per thousand units. Okay. So basis that we can calculate it.
No, sir. Silpa madam's question is contract versus uncontracted power sale, whether it can be 10 to 15%.
No, that is project to project specific. Okay, that's why I said most of the companies don't prefer building a project which has any exposure for uncontracted revenue. Okay, generally people build project where 100% it is just contracted revenue.
So,
Okay, so
sir, which means, yeah, sorry. So, which means carbon credit, if there's any revenue from carbon credit, that would not be part of the overall projections when we're using this DCF approach. Am I
no,
correct?
then if so, generally you assume by default you will assume that it's not there. Okay. Now, if the client is saying that okay, you must consider this one, then you need to pull out the underlying contract or any arrangement they have. Okay, or they have to validate or that what is their assumption and what is the basis for that. Okay. Now it's a uncontracted thing and it's a purely market driven. Okay, it's quite volatile. Okay, then
Correct.
you have to arrive at a reasonable assumption for that. Okay.
Understood. Thank you.
Okay, so in some old PPAs and all, there was a generation-based incentive which government was giving. Okay, so those were again contracted revenue part itself, but additional revenue than the PPA tariff. Okay, there has been provision in the recent PPAs for change in law. Okay, so today when I'm bidding and and participating in a bid, let's say I quoted a tariff of 2.5 rupees. Okay, basis today's prevailing tax and all. Okay, and tomorrow the government increases the GST rate, let's say from 15 to 18%. Okay, like it happened for our solar panels. The GST was earlier 5% and they increased to 12%. Okay, so that 7% increase in GST will be considered a change in law, and for that the PP has provision to compensate in the form of additional tariff. Okay, so this can also come into picture while evaluating the revenue for the underlying project. Right? What else? The other factor come into picture is what kind of the counterparty is there. Okay, whether the counterparty is a central government counterparty, it is a state government, or it is a private company. Okay, basis that the receivables gets adjusted. Okay, and you can also factor when these aspects when you are deciding for cost of equity, and because central government entities have very low risk. Okay, they don't create a lot of problem, but the state government create a lot of problems. Okay, they don't pay in time. They create a different kind of nuisance and they trouble sometimes. Okay. I don't know whether you guys have followed the news. The Andhra government, when the Jagan Mohan Reddy came, he tried to renege most of the PPAs which were signed during Chandrababu Naidu period. Okay, so there's a lot of pushback from the government and people who are having plant in that state were poorly and heavily affected. Okay, so we must take into account these who are the counterparty in the PPA. Similarly, there are issues with Telangana government, Maharashtra government, and Madhya Pradesh government related entities. They don't pay in time; they pay you after 1 year. Okay, so those aspects we need to take into account while arriving at the receivable cycle in the cash flow, right?
So just one point, in case we have any such problems on receivables, whether the government pays with interest?
Oh, that's a negotiation, madam. Okay.
What the agreement is saying?
The agreement says that they have to pay with interest. Okay. But there also, when you're valuing, then you have to go beyond the contract, because many times these government authorities don't follow them. Okay. Somebody.
Shilpa, for that matter, there are power plants which did not receive money from them, then they became sick and became IBC cases.
Yes.
Okay, so interest is not of any relevance in those kind of cases, no?
Correct.
Especially, I know some companies which are from Tamil Nadu, the Tangent Co, what you were saying. I was in one of the meetings. The company was asking this minister, sir, why don't you arrange some loan to Tangent Co so that they'll pay our this one and we'll start operations. But then the minister was saying that Tangent Co is already over funded, so we can't give them 1 rupee also. So that is the situation of those utilities, state utilities.
Correct, sir. Well said, sir. That's what I meant when I was referring that we need to be cognizant of the counterparty. The state government agencies like Tangent Co, okay, then it's very risky. Okay, and that's where if we the appropriate valuation method also matters. Okay, if you arrive at the valuation on FCFE, okay, which does not take into account the receivable cycle, okay, and let's say we have not taken the receivable cycle impact there, then it won't arrive to a appropriate valuation. Fine, there could be deductions as well. Okay, so in certain PPAs there is provision that if the counterparty pays you within 30 days, okay, or within 10 days, then they are entitled for some discount. Okay, that is called a rebate. Okay, if they pay you within 10 days, the PPA is provision for, let's say, 1% discount on your bill. Okay, so those aspects also needs to be taken into account while considering for receivable. Okay, there are in certain private PPAs arrangement and all, there are grid support charges aspect which comes into picture. Okay, if I supply to a private PPA, a private consumer, then there are grid support charges. Okay, so again, it depends from state to state and connectivity level of the consumer. Okay, in Karnataka, government has been charging so far 7% of the electricity generated. They will deduct for allowing you to supply to a private party. Okay, so those deductions also needs to be taken into account while arriving at the revenue of the project. Okay, and similarly, I think Mr. Advait, you were asking earlier that what if the PPA is only 5 years, okay, or 6 years? Then what do we do? Okay, again, since the underlying asset is typically considered as 25-year, we will go with a 25-year cash flow assumption. But after 5 years, what do we need to take? After 5 years, we can take a reasonable merchant price assumption, okay? Because merchant market is always open, and we can always sell to merchant market, okay? So there we don't need to be contracted, but that tariff we can consider, okay? That what should be the reasonable merchant price, okay? And it has to again netted off for any cost of selling into the merchant market. Okay, so and that adjustment, that tariff with appropriate adjustment can be considered for arriving at the revenue.
Thank you, sir.
So one small query. Normally, as per your experience, if the company is not able to give the minimum power, that time also any penalties are there in the company?
Yes, sir. Yes, sir. Okay.
Minimum. Okay.
So in the PPAs, there are minimum supply guarantee. Okay. So let's say under that translates to supplying 100 units in a year. Okay, you ended up supplying only 80 in a year. Then for the shortfall of that 20 unit, in the PPA, there is a rate that at this rate, you need to pay penalty. Okay, that rate could be at the PPA tariff itself, or it could be at, let's say, 50% of the PPA tariff.
And if I have more than the whatever I have agreed, I will supply so much, and I make more power generation, what will happen?
So typically, the power purchase agreements have a normal normal unit. Let's say that is 100. Okay, it says you can your minimum supply guarantee will be minus 20%, and your maximum the obligation for the off-taker, the counterparty to buy, will be capped till 110 means 10% more. Okay, if you supply or if you are ready to sell any units more than that, then there could be a different rate. Let's say 75% of the PPA tariff. Okay, so that also needs to be taken into account. Okay, let's say some client give you a very crazy or very high CUF assumption, okay, which is leading to a very high generation. Okay, then you need to check whether the whole generation is entitled for the same tariff, or the incremental generation is entitled for a lower tariff. Okay, that, or similarly, if the plant performance is showing that it is performing less than performing very low, and you're not able to meet your minimum supply guarantee in the PPA, then you have to consider penalty in every year also. In every year. Okay, so both these aspects needs to be taken into account.
Sir, I have to add to Shilpa Madam's doubt. So when we are speaking about DCF future cash flows, though in the past the company generated more than capacity power, can we take that as a basis for future cash flow beyond 100% capacity utilization?
So if there is a track record, sir, you can obviously do it. Okay. But again, from solar, obviously, you need to consider that annual degradation as well, right?
Okay.
Yeah, so you can take that if there is, let's say, 2-3 years of track record for higher generation. Okay, you can obviously consider that, and on means in normal case, anyhow, you have that annual degradation, which let's say 0.7% or 0.5% annually. Your revenue is dropping because the solar panels are degrading.
Okay,
sir, if the supply is more, power production is more, and then I sell to private, still that private sale penalty will still be there if I'm going over the capacity also, like whatever I had agreed.
No, then you will not be you will not be penalized, right? Because the penalty is only for under supply, right?
Not for selling to outsiders.
No, means you cannot like under the PPA, let's say you are obliged to sell to the counterparty, right? Then you must supply them, okay? And
after that, we can go for anyone.
It's a ROFR structure, right of first refusal. Okay.
Oh, okay.
Okay. So if there are excess, then we have to first offer them to the counterparty. If they says that, okay, I cannot take it, okay, then we, in the PPS, it's quite often there's a provision that you can go and sell it to some third party.
Sir, you mean to say the right of first refusal needs to be given to the customer himself or to the counterparty, and then sale can happen to any other person.
Yes, ma'am.
Understand correct?
Correct, ma'am.
And sir, I also wanted to understand, in all these.
Again, ma'am, having said that, it is specific to the power purchase agreement. Okay, what clause and how it is contractually agreed. Okay, but I'm telling you from my experience and what I have seen in the market.
Yes, sir. So in your experience, I also want to understand that, what are we actually dependent on? We are actually dependent on nature, right? We are dependent on sun. But there could be situations where, there could be heavy monsoon, because of which, or clouds, because of which, you are not able to generate the output. How, in your experience, know whether all the power purchase agreements, whether the supplier has been able to fulfill the commitment, or whether there has been severe aberrations.
So I would not say severe aberration, but yes, obviously there have been incidences where the power producer has not been able to meet its minimum obligation under the PPA.
And you have seen it across various players, is it? Is that a trend? So why I'm asking you this question is, should actually the person who's, see, at the end of the day, it is all about projections, right? So should we
Correct.
actually have a very conservative approach, or whether we should have an aggressive approach at the time of preparing the projections?
No, obviously, ma'am, we need to be cognizant and careful in committing a number. Okay. There are two aspects here. One is for valuation and perspective, okay, which depends upon investor confidence to level. Okay. Now, when we go to a lender for project financing, they rely on only P90 PLF. Okay. P90 means where the 90% they will ask the consultant and tell me the generation number which has 90% probability to be achieved. Okay. But for an investor, when an IPP is building a project, as I said, for wind, typically companies take 75% probability generation, which is more than P90 generation.
So to refine my understanding, so are we actually telling that when we go to the lenders, we have to have an aggressive projection, and when we are drafting an agreement with the contractor, we have to have a conservative projection?
No, so with the lender, ma'am, obviously there is a push and pull. Okay, so we will try to sell for a higher. Let's say IPP will try to claim that my plant will generate more, but the lender means most of the lenders, okay, across various geographies, they only rely on P90 and P99 also. Okay, so there is a debt servicing requirement, right? Okay, so interest and the repayment has to be made. Okay, for that they will for debt sizing they will see this P90 and P99 generation. They will always ascertain that for the 99% probability generation should be good enough to service the debt. Okay, there should not be any shortfall. Okay, so that's from the lending perspective. But in the PPA contract perspective, as I said, there is a bandwidth. Okay, it's minus 20% plus 10. Okay, within that we should choose a number, and when we are writing or committing into the contract, we should choose a number which has which is basically will not lead to a breach. Okay, we should not breach any of these boundary, minus 20% and plus 10%.
So there is some confusion in this P75, P90. Can I just take one example and explain us once again?
Sure. Okay. Let me explain you the example. Okay, let's say that typically wind projects, let's say 20% PLF is there. Okay. There is a variability angle which the consultant will calculate and arrive at. I have seen a 4%. This is called uncertainty. Okay. So 20% is P50 generation. P50 means 50% probability generation, which is statistically it is called mean. Okay, so mean or average generation of the project is at CUF is 20%. Uncertainty is 4%. If you arrive at let's say 90% probability, if you want to arrive the CUF at 90% probability, then the way we should do is calculated is this one into one is probability number into mean PLF is 20% into standard deviation is basically this much into the uncertainty, and so this is how we get a 90% probable generation. Okay, so 20% is the mean generation. 90%, if lenders will say, okay, I will not consider 20%, I will consider only 90% for arriving at the how much debt quantum they can fund. Okay, you can plug 99% here and calculate what is the 99% probability generation. So that will be further low. So the higher the probability, lower the generation it will. Is it helpful, ma'am?
So let me just ask a subsidiary question, sir. So the debt typically is going to be based upon the revenue which is generated, or EBITDA, or the debt cash
Yes.
flows.
So fine, sir. I'll come. I have a slide on financing itself. I will cover that.
Right. Okay.
So I guess we are good on this slide, right? So okay. So what are you saying? Whenever we are starting evaluation, we can first we can ask that what kind of project it is. Okay, is it supplying to a government agency? Is it a merchant plant? Merchant plant means it is fully selling to the power exchange and there is no contracted revenue source. Okay, or it is a private consumer. Private, it is called the industry acronym for that is CNI project. CNI, C means commercial and I means industrial. So commercial and industrial consumer. Okay, so if you understand that, then you should first ask these questions. Okay, whether it's the project is supplying to government or it is a CNI project. If it is CNI project, the PPA is most likely to be some 5 or 10 years. Okay, there are now 25-year PPAs also coming into picture, but they are still not very prevalent. Okay. Okay, fine. So let's move on. Okay, now coming to the financing part. Okay. So for you understand that all the infrastructure projects are quite capital intensive. Okay, and ideally none of the developers develop these projects fully on equity. They always are dependent upon the debt, right? So what kind of debt to equity ratios you guys have seen?
So we are trying to develop a project. I mean, cash flow, but let me assume that 6 is possible.
Debt equity ratio is typically referred like 75-25 ratio or 80-20 ratio. That's how it is.
1:6, basically.
Yeah. Not 1:4 is 80-20 is 4 debt and 1 equity, right? 75-25 is 3:1. Okay. 6:1 is too much, and it's highly unlikely in the Indian market.
Okay. Overseas, do you see it?
Overseas, yes, we can see it.
Okay.
But again, it has many riders. So and let's focus on what's happening in India.
Carry on.
Yeah. So as I said, all infrastructure projects are quite capital intensive, and I think generally people rely on 75% of capex. Generally rely on the lenders, banks, to fund 75% of the capex. Okay. Here only when Shilpa ma'am was asking what is whether the promoter track record and their credentials are taken into account or not. Here all it matters. Okay, the banks will not finance to any new player which has no track record and who does not have a strong promoter and all. Okay, they will try to shy away from it. Okay. Generally, credit rating plays a key role in arriving at the interest rate and all. Okay, again, interest rates could be floating rate or fixed rate. Okay, the floating rates are typically changing from a period to period. Okay, ideally, many of the financing from Indian banks is linked to MCLR based financing, right? You must have heard about it, right? Whenever MCLR changes, your underlying interest rate will also change. So MCLR plus spread is the typical interest rate structure for financing in India. Okay, there are international banks and also available and present in Indian market who can agree to an EBLR linked structure. Okay, so external benchmark plus spread can be the underlying interest rate. Okay, the rate, so these are floating interest rate. There could be a fixed interest rate structure as well. Okay, so it could be, let's say, 5-year fixed or 3-year fixed structure, and after 5-year or 3-year, the bank or parties can agree to a new rate. Okay, this financing could be local INR financing, or it could be in dollar financing as well. Because when we take dollar financing, ECB guidelines and all come into picture. Okay, so those regulations, regulatory aspects also we need to take into account. If we borrow through ECB, there are hedging requirements and all which comes into place. So all those aspects needs to be taken into account. Now the debt is size. Debt is size means the how does a lender and developer agree or come up with the quantum of the debt. Okay, it is determined basis certain parameters. Okay, the key parameters which come into place, one is the debt to equity ratio, and the other is DSCR. DSCR stands for. Are you guys aware of DSCR?
Debt service coverage ratio.
Correct. So debt service coverage ratio plays a key role in arriving at the debt sizing or debt quantum, okay, that a project can avail. Okay, and debt sizing is has anybody seen a project financing? Are you guys aware? I can request you to talk about that, how debt sizing is decided between the parties.
So we do it for typical manufacturing, sir. But for power, there is a slight difference. No, that's why we are asking you
fine,
about.
Sir. Miss, why don't I'm happy for you to talk about that. How, in your experience, how have you seen a debt quantum being determined?
Well, see, for instance, they try to ensure that there is a margin on the fixed assets. So let's say 75% of the fixed assets is what they will lend up to. That is one criteria. Then the interest coverage ratio is another criteria, and which typically will be 6 and above. I mean, and that is the profit to interest payouts. And then the debt service coverage ratio, I've recalled from long time back, it should be at least some 2+ is my sense. So these are some of the factors which are considered. when you're looking at the debt service coverage ratio while setting up a project, a term loan for a project. So then based on this, we'll also look at what is the cash flow looking like and then fix the payouts, whether they're going to be a bullet repayment or it will be quarterly repayments or yearly or whatever, or will there be a moratorium period? All of that comes into play. I think you're aware of it, sir. So
Yes, well captured, sir. You touched upon many aspects of financing. Okay. Again, let's. So there are two types of financing, right? This is the corporate financing or the project financing. Generally, I'm talking here about the project financing. Okay, so project financing is determined on the revenues and cash flows of the project, and its balance sheet. Okay, so as Sir cited that there is a fixed asset coverage ratio that's called FSCR. Okay, so in his experience, he has seen 75% of FSCR. Nowadays, most of the lenders are not talking explicitly about FSCR. The key parameters for debt sizing has been debt to equity ratio and DSCR. So there's a minimum DSCR of typically it is 1.20x, and 1.20 of what is 1.20 CFATs, cash flow available for debt servicing. Okay, so you have operating income, right? Its operating income is almost equivalent to CFAT. Okay, so your revenue minus OPEX minus taxes. Okay, whatever is left over is typically CFATs. Okay, so let's say your CFATs is 100. Okay, then and your DSCR minimum DSCR is 1.20x. Then basis 100 will be divided by 1.20, and the debt will be sized in such a manner that your debt servicing means interest payment plus amortization of the debt is not more than that quantum. Okay, so CFATs divided by 1.20 should be the limiting criteria for debt servicing, and accordingly the debt is sized. Okay.
So could you please help me understand what is CFAT, sir? What is that? I could not catch that term.
Yeah, CFAT is cash flow available for debt servicing.
Okay, thank
you. Yeah. So what will be available for debt servicing? Once your project is generating revenue, okay, you need to pay out to your operating creditors, right? Your operational creditors like your O&M contractors, your utility charge, your whatever was written in the OPEX slide, right? All those operational creditors, once you pay it out, then whatever is left over is available for the lenders for debt servicing, and that cash flow is called CFATs, cash flow available for debt servicing.
So how much of the project cost gets covered using this approach, sir? Will it be will it give you a 4:1 debt equity ratio at the end of
Yeah,
this?
so your driver is CFAT. Okay, let's say if you have a very high tariff project, right? Let's say means you have some 10 rupees PPA or 8 rupees PPA. Okay, you will have very superb CFATs. Okay, and that CFATs will allow you to avail maximum debt as possible. Okay, but in India, lenders would be shying away to give more than 4:1, means 80, more than 80-20. Okay, so your let's say project cost is 100, so lender will limit their debt to 80. Okay, and they will ask 20% to be funded through equity.
Right. So that means that if you're looking at the capital project cost of let's say 100, then typically let's say the EBITDA should also be close to. I mean, the revenue should be close to 50 at least, or what will it be like? Do you think that what is a viable number from?
No, fine. So let me write it out. What are you saying?
So suppose the capital expenditure is 100 in the project. As per the debt equity ratio, the maximum debt which can be taken is 80, let's say.
Correct.
Now, to service this 80, let's say there's an interest cost of 10, or so 8 will be the interest cost, plus there will be repayment over a period of let's say 10 years. So about 8. So about 16 has to be paid every year, roughly.
Typically, okay,
So-
let's say it's a 15-year debt tenure. Okay.
Mhm.
Okay. So even let's say if it is a uniform payment, so 80 divided by 15 is per year you have to pay this much,
Right.
right?
Right.
Per year. Okay. Now let's say your interest rate is 10%. Okay. Right. 10%. Interest rate. So how much will be your interest payout?
Let's assume 8 rupees for simplicity.
Yeah. Okay. So per year, how much your debt servicing will be?
13.3.
13.
Right.
Okay. Okay. Now, when you're sizing the debt, okay,
Then
so
interest payout, we have to do a reducing balance method, right?
correct.
So how much will
we
be
are
the
just
revenue? We're just trying to
for
get to
this-
revenue. That's it.
Yeah, correct. So your debt servicing is this much. Your revenue should be 1.2x of this. Okay, 1.20 DSCR minimum, I said, right?
Okay, got it.
So your revenue should be
That's a
generating.
cash flow available, right? Not revenue. That's cash flow available.
cash
for
flow
Yes,
debt
available.
service.
correct.
Yeah.
Sorry. Yeah, so this should be CFAD. Okay. Now this is CFAD. Let's say it's an 85% EBITDA margin. Okay. So this much divided by 85% should give you a ballpark revenue.
Right. And this ties into your other number on the left-hand side, which is some 18% also roughly.
No,
Which is
again,
what we-
we need
That's
to
a
arrive at
coincidence,
what
maybe.
is, yeah, it's a coincidence, but we need to arrive at, okay, so 100 is the project cost. Okay, so typically for solar project, 5 crore per megawatt is the cost. Okay, so this is, so what does it mean? It's a 20 megawatt. It's a 20 megawatt solar plant. Okay, how much it will generate? At let's say that at P9, this is P99. Let's say at P90 it's 19%. Okay, so at 19%, how much it will generate? This was 20 into 19% into what is the formula? Somebody remembers? Capacity into CUF into?
That's your USP, sir.
No, 20,
No,
24 into
that's-
365.
8760.
Correct.
8760. Yeah.
Same, yeah, same. Whatever sir said, it's same. 8760 is 24 into 365. Okay. So this much is what this is megawatt hour. Okay, megawatt hour means it's 1000 units. Okay, and let's say tariff is 2.5 rupees is tariff. Okay, this is INR per kilowatt hour. Okay, so what would be in megawatt hour? Now I can. So this much into this is 1000 rupees divided by 10 to the power 4 is your crores. Okay, so my revenue is just 8.3 crore. Okay, wherein I need this much crore. Okay, so this tariff should be much higher, right? Understood, right?
Yeah, so it should be at least 5, 6.
Yes, sir.
It should be at least 6.
Yeah, it's kind of. Yes, I'm around 6. Around 6 is kind of like 5 maybe.
So straight viability of the project for debt funding, etc., you can get from this formula. It's very nice, in which you captured it.
Okay, so this is the goal seek tariff 5.66.
Yeah.
Okay, so minimum that one, but you have seen in the market, this is not the rate. The new solar rates are roughly around 2.5 or something. So basically, this interest rate is not 10%, it could be, let's say, 8%. Okay. Then what happens? This needs to be how much?
Goal seek. So
16.56. This revenue requirement.
16.56. Yeah.
No? See, so if I drop the interest rate to 8%, it becomes 4.98. Okay? Maybe I need to drop the project cost further. Okay, so if somebody is building the project at not 5 crore per megawatt, but maybe let's say 4 crore per megawatt. Okay, so 4 crore per megawatt, then 80% of this.
Okay, so we'll get a maximum viable capital expenditure also using this. Yeah.
Okay. You see, it dropped to 4 rupees around. Okay.
Considering
So-
that the time now is 9:30, can we all agree to continue the session for 15 more minutes?
I'm okay.
Yeah, Mr. Barun.
Yeah, I'm okay.
Yeah. Yes. Okay. I think let's come back to the slides. Okay. I hope many of you could have followed the.
Yeah, this is very
calculation.
useful. Very, very useful, sir. Very useful.
Okay. Fine. So on financing, as we said, debt equity ratio and DSCR are the primary factors which determine the debt quantum. Okay. Now, what are the other things we should take into account? That amortization schedule, right? Generally, developers prefer a back-ended amortization schedule so that we have more FCFE upfront. Okay. If my project is generating 100 and if I pay less to the lender, then more will be left for the equity. Right? So generally, as a developer, we prefer a back-ended amortization schedule. Okay. Apart from that, what else? There are restricted payment conditions, RPCs. Okay. So these govern distribution to the investor. Okay. Certain conditions must need to be met before making any distribution or taking out money from the project. So those are called RPC conditions. Okay, and these RPC conditions determine how our distribution should flow. Okay, and why distribution? Because when we are following the distribution discounting method, that's where these RPC conditions take into picture, right? RPC conditions drive your distributions. In certain financing, people have considered very tight DSCR, okay, and there are dividend lock-in DSCR as well. Okay, so if your DSCR, if your project is performing not well, and if you have agreed that okay, minimum 1.5x DSCR should be there, any cash flow above that 1.5x DSCR should only be distributed. Then all those aspects needs to be taken into account, and only additional cash flow should be considered for distribution. Okay. If it is an operating project, we must check whether there have been history of covenant breaches. Covenant breaches means if there are default DSCR agreed into the financing agreement, let's say it is 1.05 or 1.1x, okay, and the project has just barely able to meet the debt servicing, and the financial year ended with a DSCR of let's say 1.01. So as per the financing agreement, you are exposed to a penal interest. Okay, you breach the covenant and you are exposed to additional interest, and hence your interest expenses and all will increase. So what does it mean from a valuation perspective? Okay, you cannot obviously carry an additional interest indefinitely in the cash flow. What it means is then the promoter needs to bring in equity in day one to reduce the debt so that your debt servicing is reduced, and when your debt servicing is reduced, your DSCR will improve. Okay, so your equity infusion has to come into picture, and then you will not charge additional interest on ongoing basis. Right, so that's how it will work. And also there are cash sweep arrangements in financing. Okay, so if you have profit, okay, after debt servicing, whatever is cash, whatever additional cash surplus cash is left, Okay, there are a mechanism. Okay, the lender will say, okay, 25% of that you give it to me, 75% you take it away. Okay, so that 25% of cash flow you can again utilize for debt reduction, and 75% you can utilize for distribution. So these aspects are taken into account for arriving at the distribution from the project. Okay. Now we also must take into account the reasonables of interest rate assumption. Somebody may say, for valuation perspective, what should they say? May say an IPP, if they will be obviously interested in maximizing the value of the project, right? And for that, what will they claim? Will they say to consider a higher interest rate, or will they say to consider a lower interest rate?
Lower.
No, right. So they may say, sir, let's say 6.5% interest rate you plug throughout the life of the asset. What would be your response, sir?
See whether it is a floating rate or a fixed rate. If it is a floating, definitely will go up. If it is a fixed, as of today, if it is there, then that's good only. Otherwise,
Okay,
6.5 in the current situation is a wrong assumption, because when the minimum rates are only going against 7.5 rate.
Correct, sir. So you can, and how do you quickly benchmark it?
MCLR on.
Yes, so you
MCLR.
can see, yes, you can see MCLR of the banks, okay, which is publicly available. Okay, that you can consider. Okay, also there are certain adjustments. There are listed bonds and all, okay, where you will get the credit rating and the interest rate as well. Okay, so that also gives you a benchmark. Okay, and you can always adjust the interest rate for the credit rating of the project SPV. Okay, the credit ratings looks like this one. There are these are international agencies, Fitch, S&P, and Moody's. They have corresponding local in India-based credit rating arms. These are called CRISIL, ICRA, and India Ratings. And there is one more leading credit rating agency called CARE. So these are credit rating agencies. Okay, and these are the typical credit ratings they assign. Okay, so any credit rating BBB plus, BBB minus plus above is called investment grade. Any credit rating below that is called a speculative grade, and those are not preferable. Okay, if your credit rating is non-investment grade, then banks will shy away from funding that project. Okay. There is some rule that you see, if you could notice that borders, right? They have categorized the rating. Okay, so BBB minus, BBB plus is called BBB category. Okay, then A minus, A plus is called A category. Then there is a AA minus, AA plus. It's called AA category. Okay. So whenever your credit rating upgrades from one category to other, typically you will get a 25 basis point improvement in the interest rate. Okay, and within the category, at least for each notch, you can get some 10 basis point improvement in interest rate. So that's a rough ballpark you can consider for arriving at your estimated interest rate. Right?
Sir, I'll add here one point.
Yeah.
Actually, like to add to your point, what are grading we are getting based on this? There is a organization called FIMDA. They'll monthly publish default spreads, all those things. We need to take that also, like as a valuers, we need to take that into account while arriving interest on our vote.
Sorry, sir, I don't know
FIMD, fixed instrument. This one organization.
Yeah, I understand. Yeah, one organization is there from that. Okay, I have hardly seen anybody using that, sir. Okay. But typically what we see is that if you will find into the internet what is the recently listed any NCD or any bond issuances, okay, it will come up with a credit rating. Okay, let's say you can search it out. Okay, I think in the interest of time, let's move on. Okay, but you can easily search in the internet that what are the recently listed NCDs or bond issuance sale, and you can get the interest rate as well. So you will get the credit rating and interest rate, and I just explained you that how can you adjust the interest rate for credit rating. Typically, the renewable projects, okay, have been rated AA minus, sorry, AA, between AA category. Okay, so in this AA category, you can find a renewable project where the off-taker, okay, where the counterparty is central government. If it is a state government and all, then you can find between A category, okay, A to BBB category, you'll find that where the counterparty is state government. Okay. So I think that was from a financing angle. Okay. Again, now financing assumptions are relevant because these assumptions affect your FCFF and FCFE and distribution aspects, right? Because all this interest expenses, whatever you will charge in P&L, that will lead to tax calculation. Okay, so that will affect your FCFF and FCFE and interest rate. Again, whatever will be left out, right? The debt servicing, if it is higher then or lower, then it will affect your FCFE and distribution. Distribution will further be affected by RPC conditions and all. Right? I hope you guys could follow this one, right? Okay, then I'll quickly glance through on the other aspects of depreciation and tax. You know that this depreciation book and tax will play a key role in arriving at the financials, right? What kind of book depreciation and tax depreciations are allowed in on those specific equipments, their asset life and all needs to be taken into account to arrive at the depreciation, right? And from a tax perspective, obviously there are corporate tax and there are withholding tax on shareholder loans and there are distribution tax on dividend distribution. So all these aspects needs to be taken into account to arrive at the post-tax valuation of any project or entity. Right? Even there are concessional tax regimes for manufacturing company, and renewable energy generation and electricity generation is classified as manufacturing from a tax perspective. Okay, so although the corporate tax is quite high for normal businesses, for manufacturing businesses, the government has given 15% plus surcharge and another, which comes to around 17.16% total corporate tax payable. For withholding tax, it's typically 15% on the shareholder loan, and distribution tax is 10% in form of TDS. Okay, so these assumptions needs to be taken into account to arrive at the net cash flow. Okay, right. Then what else? Right? What else is left?
Sir, I also wanted to understand, in your experience, typically lenders, do they become shareholders? Will there be conversion of debt to equity? And in that case, should we actually do a valuation? I mean, of course, there will be a valuation that.
Yeah. Yeah, any conversion as per, I think, Companies Act,
Again,
the fair market valuation is required, right?
No, sir. I mean, my question was, in your experience, have you seen, the lenders converting their the whatever money that they have actually put in the project into equity? Have you actually?
No, I have not
experienced
seen,
that?
but I think in our panel, I forgot the name. I think one person is exposed to that one. Forgot your name, sir. I think you are referring to tangent code related issues, and you got exposed to some stressed asset,
Madam, what happens in when there is a CDR and SDR where 50% of the equity can be taken over by the lenders when there's a default. Okay, that is a situation where there's a default and the company are not doing well, in which case the value of the equity is literally zero. But normally they convert the shares only at ₹10. So if the company has a value, then the bankers need not convert into equity and all that. Why do they convert? They convert into equity because to reduce the interest exposure of the company. Okay. So here, that means the company is not in good position, is not able to pay its debt on time, is not DSCR is much below whatever it is, or no generation like that. At that stage only, they convert the debt into equity, in which situation, normally the value of equity is zero. But to convert for that, they normally do it ₹10 per share at the face value.
So sir, so is my understanding correct that only lenders will only be bankers and financial institutions, and it will not be VC funds and private equity firms when it comes to
Is a private equity? No, private equity firm is already in equity only. Okay.
No,
So
but then mostly they will be subscribing for CCDs or something like that, right? In that case, I'm not
that I'm
necessarily.
not sure, because I've seen cases where State Bank and all the nationalist banks and PFC and all these people, no, they convert the debt into equity as a part of the scheme, SDR, as debt restriction schemes. No, that they do. I'm not aware of the funds how they do, whether they are also covered in this or not, because this is more like an RBI guideline. RBI guideline should be applicable to Indian financial institutions, not the. I don't know but I'm not sure of that.
Yeah, Barun sir, can you give us some inputs whether venture capital funds and private equity funds, whether they invest in power projects, and even if they were to invest in power projects, whether what will be their model of investing, whether they'll invest as compulsory convertible debentures, and which subsequently possibly will be converted into equity.
So, ma'am, venture capital funds, they generally don't invest into infrastructure business, but obviously private equity companies do. Okay, there are many organizations in India which are backed by private equity. Okay? So, like I quoted Renew Power, they are backed by Goldman Sachs and CPPIB. Right? Similarly, there is Azure Power, which is backed by CDPQ. Okay, we have platforms, renewable platforms backed by KKR. Okay, so the private equity companies obviously fund and invest into the renewable business. They obviously consider shareholder loan kind of structure. Okay, where the equity, where they make investments through debt instruments. Right, these instruments could be CCD or non-convertible loan itself, like ECB. Okay. Can be OCDs as well, but I've primarily seen like ECB and CCD. Okay.
So, in your experience, those who are subscribed to CCD, will they actually convert into equity at a later point in time? Considering that this.
No, so these are contingent issues, ma'am. Okay, why will an investor convert CCD into equity? Okay.
That's exactly what was my question. That's the question, because see, at the end of the day, why would a person, a CCD would get converted into equity only if the valuations will actually be higher at a later point in time. Correct? So these are all finite life projects, right?
Correct.
So,
these are contingent measures. Okay, when there are business partners in the project SPV and all. Okay, and there are certain issues between the partner and all. And one investor has invested in the project through CCD, and if certain conditions are not met, okay, then they will try to take governance of the project and get involved more into the project, into the company's operation and all. Okay, and for that, what will they do? They convert the CCD into equity so that they become majority shareholder and start taking active role into the board and management of the company. Right?
Okay, sir. Okay.
Yeah, so I think most of the things are covered. One key aspect we didn't touch about is the discount rates. Okay, whether we are discounting through dividend discounting approach or FCFE discounting or FF discounting. Okay, the key discounting factors would be the weighted average cost of capital, right? When we are using FCFF approach, or it could be just cost of equity when we are using dividend discounting method or FCFE discounting approach. Okay, so what should be the appropriate cost of debt and cost of equity? We must be cognizant of, and we must choose a risk-adjusted cost of capital whenever we are deciding. Right?
Friends, we have come to the end of the session.
Yeah.
For the constraint of time, it's already 9:50. So, on behalf of Bangalore Valuers Association, I request Mr. Ravishankar Devarakonda to formally extend vote of thanks.
Thank you, Shilpa. Thank you, Mr. Barun Rai, for the explanation and the detailed guidance to our members regarding this green energy options and valuation of the green energy companies. In fact, these are all more like a power generation companies only. Instead of a traditional thermal power, now we are going into green energy, because I was also involved in certain power plants earlier. Okay, the GMR power, which was a naphtha-based thermal, where we had a power purchase agreement, which was a you call it dual tariff. Actually, there's some amount of fixed. As he said, no, the PPA terms is very important in these cases. The PPA can be a dual structure. That means there's such an amount of fixed element and such an amount of variable. Fixed element will cover your fixed cost, like interest, fixed expense and all that. Then your value will definitely be more. But if the entire thing is one common element, then it's difficult. I was also involved in another power plant as an IRP, where we had a PPA, but the PPA had to be cancelled because we could not meet the generation requirements because the coal tariff has gone up. Whereas for a green option company, for green energy companies, raw material cost problem is not there. Upfront, you know what is the total cost involved in to be put in. And the operation cost is very less. So the valuation is not linked to your raw material cost, which is more like a coal prices going up or naphtha price, crude oil prices going up. That kind of problem will not be there for them. And but as I said, the initial cost of installation will be very high for a green energy. In fact, I was also involved in this nice tool road where we want to put some this wind turbines there, but ultimately we realized that it's not viable in case of a city kind of an environment. He also explained the various elements, other elements which are taken to be consideration, like capex, power purchase agreement, terms of the power purchase agreement, and a promoter's ability to fund in case of losses. Like I said, the Tangentco is not paying regularly, then the promoter should be able to put that money into the company to take care of to run the company. Otherwise, the company will be shut very soon. Once the company is shut, very soon the entire investment and machinery, they become junk very soon. So he should be able to carry on even when the payments are not coming regularly. And even the GMR example, what I said, we were connected to this KPSCB. But what they KCB, what they said is that since the KEB is not doing well, they wanted a guarantee from the government of Karnataka and also an escrow arrangement of the receivables of the for that utility, that KEB. So that kind of arrangement also can be thought of, but you don't get those kind of arrangements generally for this kind of companies. But if they have, then the valuation can definitely be given a decent valuation. Then he's also taken us through the full this how to fund, how to finance, and how to do a financial viability of the project. And the objective of that session was that if the company is not meeting any of the covenants like DSCR and debt equity ratios, definitely the banks are going to recall the loans, which will again affect the viable valuation of the company in a very adverse way. And finally, he also given us the international scenario and national domestic total generation and everything about the power generation scenario in India. Thank you, Mr. Barun Rai. Thank you for spending your time and enlightening all of us on these issues. Thank you once again.
Thank you, sir. I'm highly obliged for your presence and all the questions and interactions you have. So thank you all so much.
1 minute, Mr. Barun. Vijaya, can you please share your session? Can you please share your screen?
Yes, ma'am.
On behalf of Bangalore Valuers Association, we would like to present this memento for the speaker. The memento will be, sir, can you stop sharing? We would like to present this memento for the speaker. This will be couriered to you, sir. I thank everyone for their participation. Have a happy weekend. Bye for now.
Yeah. Thank you. Thank you so much.
Thank you so much, sir. Thank you.
Thank you very much, sir.
Thank you.
Shilpa ma'am, can I end this session?